Hi everybody, welcome back to the 10th of an Hour with Griffin Bridgers. For this episode 31 of the 10th of an Hour, we're going to talk about a little known tax principle known as equitable recoupment. And we're going to talk about where you most often see this in the world of estate planning, which is when there's a potential income tax refund due to an estate tax increase. Now, as always, this presentation is not intended to substitute for legal or tax advice. So, to set the stage, since this is a very technical discussion, where does this apply? Well, basically, if you or a client is seeking to sell an asset that you've inherited, this could potentially be an issue here, especially if, and sometimes you don't know about this, it might be going on in the background, but you especially want to be wary of this if there was an estate tax return filed that was later audited and you're somewhere in the audit or appeals process with respect to that estate tax return. Now, before we get into the weeds on this, there is a link between the estate tax and income tax. Essentially, estate tax is designed to replace income tax on the growth and value of property that accrues during a decedent's lifetime. And the way this is done is because the estate tax is assessed on the fair market value of assets either at date of death or at the alternate valuation date if that's elected. And right now, we've briefly discussed in the past this large loophole which could be eliminated by Biden. That's a separate discussion, but the estate tax exclusion of 11.58 million really allows you to step up the basis of the first 11.58 million in assets without paying any estate tax. And then if the asset is sold after death, the stepped up basis will reduce or eliminate the income tax to the estate or heirs. However, as we've talked about, the underlying theme behind this is what if the IRS comes back and challenges the valuation of estate assets? Now, it's important to note, we've talked about this, in a very early episode, that there are limitations periods on how long the IRS has to come back and try to collect an underpayment of tax from you after the filing of a return. Similarly, after the filing of a return, you, as a taxpayer, have a limited window of time to seek a refund for an overpayment of tax. Now, estate tax related limitations periods could run longer, however. For example, if there's a basis overstatement of more than 25%, maybe on the estate tax return, the limitations period could be extended to 6 years, possibly for the estate tax return, maybe even for income tax returns. And if there's a portability return at the death of a first spouse, the limitations period may be extended through the filing of the surviving spouse's return in 3 years after. But it's important to note, too, that the limitations period is only for the IRS audit. So the IRS can start an audit within 3 years, but the completion of that audit takes much longer. There's usually an audit, a notice of deficiency, maybe an appeal at the IRS level, and then maybe even a tax court petition and potential appeals down the road. So this can take years and years to settle out if there's a challenge to the estate tax return. So let's assume that there is a value understatement on the estate tax return and then the asset is sold. Well, what happens is there's a deficiency in the estate tax, but potentially an overpayment of income tax on sale, because if the basis of the underlying asset is increased due to an increase on the value on the estate tax return, what that means is that the seller had a much higher basis than was reported, and they ultimately overpaid the income tax on the gain of the sale. So by the time the appeals are over, usually more than 3 years will have run, and it's too late for the seller in this case to go back and seek a refund on their income tax overpayment. And they can't argue for a longer limitations period of like 6 years, because this would be a basis understatement and not an overstatement. So what can you do in this case? It wouldn't necessarily be fair for the IRS to collect a double tax here, and that's where this principle of equitable recoupments comes into play. So, as long as certain requirements are met, you may be able to seek this equitable remedy called equitable recoupment to get a tax refund after the limitations period is run. Now, there's certain strict requirements that have to be met. One, the refund has to be time barred, like we talked about. Two, the refund has to be generated by a single transaction item or taxable event. Three, that transaction item or taxable event has to be inconsistently subjected to two taxes, maybe an increase in estate tax but an overpayment of income tax, for example. And then if two or more taxpayers are involved, there must be a sufficient identity of interest, such as between an estate and an heir, such that you could treat the separate taxpayers as one. So the circumstance in which it is easiest to satisfy these is in a situation like we described with an estate tax deficiency, which creates an overpayment of income tax when the asset which generated the estate tax deficiency is later sold. So there's some other points to make here. One, that this cannot be used offensively to create a claim or jurisdiction. So there has to have been an existing maybe a tax court petition or appeal relating to the estate tax deficiency. So either the seller needs to file a protective claim for refund before the 3-year limit runs out. That may be a good idea for you if you're contemplating a sale of an asset inherited. And potentially you need to look at, too, does the personal representative of the estate need to take the estate tax case all the way to the tax court instead of just settling it out? And similarly, you have to look at, does estate tax have to be paid to meet the requirement of there being a double tax inconsistency here? The IRS would potentially argue that there has to be, but it's important to note that this is an equitable remedy, and the underlying spirit is that if all other requirements are met, the IRS cannot keep monies which in equity and good conscience belong to the taxpayer. So, in the rare event that this applies to you, equitable recoupment can be a good backdoor strategy for seeking a repayment or a refund of an overpayment of tax if you end up in this situation. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.